What if I told you that if I lost everything today and had to start all over again, there's only one strategy I would go back to without hesitation. It is simple, it works in any market condition, and it brought me over a win rate of over 80% when I apply it properly. This is the exact strategy I still use to this day, and I have taught it to beginners, to advanced traders, and to people with no clue what a candlestick was when they get started. If you are into SMC, ICT, price action, great. But today I'm gonna give you something way more straightforward. Something you can use today. So grab a pen, take notes, because by the end of this video you will know exactly how to find high probability breakout trades. How to enter them, how to manage your risk, and how to get consistent with it. Let's get into it. So let's start at the very base. Support and resistance. Support is a level where price keeps bouncing off and refuses to go lower. It acts like a floor. Resistance is the opposite. It's where price struggles to go higher. It's like a ceiling. These are not just random lines. These are psychological price levels where buyers or sellers likely to step in. Especially big players, institutions, bank, etc. Now here's the trick. When price breaks through one of these zones, that level tends to flip its role. Support becomes resistance after a breakdown. Resistance becomes support after a breakout. This flip is extremely powerful, and if you watch how price reacts when it retests the level, you will know exactly whether to trust a breakout or not. Now before we enter a trade, we want to know what the market is doing overall. Market structure just means, is the market trending up, down, or going sideways? If it is an uptrend, you will see price making higher highs and higher lows. In a downtrend, it's lower highs and lower lows. We always want to trade with the trend, not against it. So if you're in an uptrend, you're looking to buy breakouts above the resistance. In a downtrend, you're looking to sell breakouts below support. Going against the trends means you're fighting momentum, and momentum almost always wins. A breakout is when price smashes through a key level, like resistance or support, with strength. It's not just about a wick or a little poke above the level. You want a full, strong body close that closes beyond the level. Wicks can fake you out. You've probably seen it. Price breaks out with a wick and then instantly reverses. That's not a real breakout, that's a liquidity grab. So here's the rule. Wait for a candle to close fully above resistance or below support. Ignore weak candles and indecision moves. And even better, we combine the breakout with something called an engulfing candle. Let me explain. An engulfing candle is one of the strongest signs of momentum in the market. Here is how it works. A bullish engulfing candle forms when a green candle completely covers the previous red candle's body. A bearish engulfing candle is the opposite. It swallows the prior bullish candle. When you got an engulfing candle right after a breakout, that's your confirmation. That's the market saying, yes, I want to go in that direction. So we are not just guessing or reacting emotionally. We are waiting for evidence before entering. Alright, let's put it all together. Here is the exact 5-step strategy that I use. Step 1. Identify the trend. Go to your 4-hour or your 1-hour chart and simply ask, is price making higher highs or higher lows? Or is the trend making lower lows and lower highs? That gives you a trend direction. No trend is no trade. Step number 2. Find support or resistance. Look for levels where price has reacted from 2 or 3 times before. Zones where price keeps bouncing or rejecting. These are your battle zones. The breakout will happen from here. Now here's where most traders mess up. They only enter on the wick. We don't do that. We wait for a strong candle body close above the resistance, like here. Or we wait for the other way around underneath support, like here. Because here you can see it's in an uptrend and here you can see it's in a downtrend. Here you will see that we have an engulfing candle as well. This is likely for a breakout. Here you can also see that we're in an uptrend. Also you see that we have a clear breakout above the resistance, as you can see here. Here you can see that we're in a downtrend and that we have an engulfing candle with the breakout underneath the support. that's when price is likely to go down. This candle needs to be clear, decisive and not a weak doji candle. Once the breakout happens, wait for a clean engulfing candle in the direction of the move. This is our green light to enter. As you can see here, we have a bullish engulfing pattern, and as you can see here, we have a bearish engulfing pattern. Don't skip this. The engulfing candle adds the strength in the move to filter out the fake outs. Step number 5. Here's how you manage your trade. You wait for a strong bullish candle, and at the close of the bullish candle, you place your trade. Here you can see we have placed a trade and we are targeting a risk to reward of 2. You put the entry on the close of the bullish engulfing candle and we put the stop loss underneath the wick. Now you can see we are targeting a 2-to-1 risk to reward ratio. In a downtrend we do it the other way around. We wait for a bearish engulfing candle, we put the trade at the close of the engulfing candle, we put the stop loss above the wick of the bearish engulfing candle, and we target a 1-to-2 risk to reward ratio. With a 1-to-2 risk to reward ratio, you can win just 50% of the time and still be profitable. But we are aiming for 70 to 80% win rate when you're doing this right. As you can see here, we are on the pound against the Swiss franc on the 1 hour time frame. As you can see here, we have a strong close above the resistance. What we now do is we put our long position on the close of the body, we put the stop loss underneath the close of the wick, we put this at a 1-to-2 risk to reward ratio and we will see what happens. And here, as you see, price hits the take profit. That's number 1. Let's go to a second example. As you can see here, we are on the British pound against the Canadian dollar on the 1 hour chart. As you can see here, we are in a strong upwards movement and we have the resistance laying above, which already been tested a couple of times here. Now we will see before we have a strong close above the resistance so we can enter our 1-to-2 risk to reward ratio long position. Let's see what happens. Here you can see we have a strong close above the resistance. What we now do is we take our long position and we put it at the close of the candle. We put the stop loss underneath the closure of the wick. We go for a 1-to-2 risk to reward ratio and we wait before we see what the results are. As you can see right here, we have our 1-to-2 risk to reward ratio. Let's go for another example. As you can now see, we're on the euro against the Australian dollar on the 4 hour chart. Here we have the support laying underneath us and we're trying to find a breakout trade which we can trade in a sell position. As you can see here, price breaks through the support and we're trying to take a short position. So we're going here, take a short position, putting it on the closure of the short, putting the stop loss above the wick, and we're trying to aim for a risk to reward ratio of 2. Let's see how it plays out, because we also see that the price is making lower lows and lower highs. So let's see what happens with this trade. As you can see, it took a couple of days, but now our take profit is hit. Now you also see that in short positions we have the same momentum and we can perform the same trade as we can also do in long position. Now let's go to another trade. As you can see here, we're here on gold against the dollar. What you will see is that we waited for a strong closure underneath the support, and that's where we entered the trade. We were targeting for a 1-to-2 risk reward ratio, and as you can see here, we entered the trade here, and here was our take profit. Also a successful trade which we shared with all our members for free. This is not some flashy one-off strategy. This is something you can master and use consistently. Whether you're trading Forex, gold, indices or crypto, I recommend start by backtesting it. Go on TradingView, mark up your charts and test this setup 50 times, 100 times. See how often it works when you stick to the rules. Then try it live, start small, get confident and grow from there. If you found value in this video, smash the like button, drop a comment if you have questions, and most importantly, join my free trading community on Telegram. We have got over 325,000 traders learning, growing and copying my trades in real time. I share live signals, breakdowns, and we do weekly Q&A. The link is in the description. Come say hi and I will see you inside. Let's grow together.